Waste Management, a leading environmental service company in the market, has seen favorable results in 2022. Its revenue increased by 10% and net income also grew by 23% year over year. However, despite the positive financial performance, the stock price is down around 2% since then. Today, we'll be taking a 3-step approach to thoroughly evaluate the company and determine its fair value. Step 1. Margin of safety. We'll be looking at Waste Management's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into Waste Management's financial statements and assess critical metrics and ratios. Step 3. Valuation techniques. In this step, we'll be using a combination of valuation techniques such as discounted cash flow and discounted dividend to gain an insight in the value of Waste Management's business. By using these methods, we can determine whether the stock is currently over or undervalued in the current market on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of Waste Management as an investment opportunity. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. Where we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. Where we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from just over $2 billion in 2013 to almost $3.5 billion in 2022. The average EBIT growth during this period is 6.3%, which is no change in the margin of safety looking at our scale. The margin has also gone up over the years, going from almost 15% in 2013 to 17.4% in 2022. The average margin growth during this period was 2.1% on average, which is a 5% deduction from a margin of safety. Next 2 metrics that we'll be looking at are the dividend growth and the payout ratio. Dividends have gone up over the years, going from $1.46 a share in 2013 to $2.80 a share in 2023. The average dividend growth during this period is 6.8%, which is no change in the margin of safety. This with a payout ratio that is currently sitting at 48.5%, which is no change in the margin of safety once again, looking at our scale. The final 2 metrics that we'll be using are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Waste Management, this is just under 3 years, in this case, a 295% debt to EBITDA ratio, which is under the 300% that we like to see. In this case, no change in the margin of safety, though, on this metric. The return on invested capital for Waste Management is sitting at 9.6%, meaning that the management is pretty effective at allocating capital. No change in the margin of safety on this metric either, however. Let's go look at the valuation models next to determine the intrinsic value of Waste Management. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Waste Management going from 2013 to 2022. The average growth rate in the free cash flow annually during this period has been almost 10.5%, and I'm projecting their future free cash flow to grow by 8% annually for the next 10 years. With this percentage, we'll determine the future free cash flow for Waste Management and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $49.4 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of almost $35 billion. And dividing this by the amount of shares outstanding, we had the discounted cash flow price per share of $85.49, which is almost a 48% downside of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Waste Management going from 4 years ago to the current year. The average growth rate in the dividends during this period has been 8.15%, and I'm projecting all of their future dividends to grow by 7%, and we'll use a discount rate of 8.5% once again in this valuation, giving us a dividend discount model price per share of $199.73, which is a 22.22% upside from the current price. The next model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Waste Management is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that a company with no growth should never have a PE exceeding 7. Looking at all of these metrics, we get a fair value of $87.42, which is a 46.5% downside from the current price. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Waste Management, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 30.18. All we have to do to get a fair value is to then multiply by the earnings per share that Waste Management is generating, which is $5.64 a share, giving us a fair value of $170.22, which is a 4.16% upside of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years. On an average, it has been sitting at 1.7%, while the current yield is sitting at 1.68%, indicating that it's very close to fair value on this metric at the moment. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 27.24, while the current PE ratio is sitting at 30.57, indicating that it's slightly overvalued on this metric, giving us a fair value of $153.56. This is a 6% downside from the current price. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation next. Coming to our final overview, we have imported discounted cash flow, discounted dividend, grains valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $139.29. A margin of safety we've determined earlier, using a 25% standard margin of safety and deducting 5% from it because of the margin growth, leaving us with a 20% margin of safety. Applying this margin of safety, we get a fair value of $111.43, and with the current price of $163.42, we get a pretty big downside of almost 32%, indicating that's currently a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.